Students, we are coming to the format for calculating of the book profit under section 115 JB subsection 2. As we know, the math is been prepared according to the Companies Act provision as per the P&L account. So here the P&L account as per the Companies Act, whatever it is being given in the problem, you are going to write it down the figures here. So next, what are you going to add? The following debit made in P and L account. As I told you, the MAT is being introduced for those companies, those who are doing very good, they are paying a good dividend to the shareholders. But when it is coming for the income tax payment, their amount is either very low, nil or negative. So they are called zero tax company. And the provision has been introduced for them that at least a minimum amount can be paid by way of tax. So now what we are going to add? The following debit made in P and L account. The first is provision for the diminution in the value of assets. So you are going to write it on the inner column. So this is a provision. This is not an actually expense. It is in the hands of the company only the amount. But they have made a provision. It means again when the shareholders are looking and they'll be very happy towards this because they know that this is an expense but it is in their own hands. They have not been done any expenditure towards it and the money is in the company itself. Next is provision for the loss of subsidiary company. So again you are going to write they had made the provision for the subsidiary company if the company is an holding company. Next, provision for the unascertained liability. Unascertained liability is for the reserve for bad debts. As we know, they have made certain reserve for the bad debts because the debt may be a recoverable or may not, and again they have made a provision. It means this is also is not an expense to the organization, to the company. It is only they have made one provision. Again they are on the safer side if you are going to see all these three provisions. Next is reserve. Reserve is transfer to any reserves. So reserves are also a kind of amount that they have been kept for their safer securities to meet the uncertain timings or any calamities so that it will be helpful for them. Next is income tax paid or payable or provision for income tax including surcharge and cess and interest on income tax. Here again income tax either they have been paid, they are also included in the expenditure. If they are about to payable, they are also included in the expenditure, or they had made any provision for the income tax including the surcharge and cess before in hand. That is also is one of the provision that they have been made. And interest paid on income tax, any interest that they have paid for the income tax that is being shown in the P and L account that they have already been debited and a kind of expenditure, then that also will be added back to the net profits. Next is depreciation as per P and L account, including the depreciation on the revaluation of reserves. So here depreciation what is an also an reserve. As we know depreciation is also an reserve. It is been allocated but they keep certain amount as a part of depreciation. It is not expenditure. They are keeping aside the amount. When they purchase the new one, that amount is added back. So it become helpful for the company. When they are purchasing, they are not incurring a huge cost. So depreciation as per the P and L account, it is also included the revaluation reserve. Now deferred tax debited to P and L account. If it is debited to P and L account, it appears on the expenditure. So here deferred tax, if it is debited to P and L account, you are going to add. Suppose if it is credited, you are going to reduce. Here, this shows us a liabilities. Either they have paid the tax well in advance and they are on the safer side. Next, dividend and proposed dividends. Dividend distribution tax. Any dividend, either they have paid a dividend or a kind of proposed dividend or dividend distribution tax to the shareholders. That is also is been added here. Next is expenses on exempted income. See the expenses on the exempted income. What are the exempted incomes? Exempted incomes are section 10, 11 and 12 for the uh, companies under section 115 JB on subsection 2. So here only excluding section 10 subsection 38 you're going to add. See again on the expenses they have made on the exempted income. All this when you are going to see, actually they have not incurred any expenses at all. And if the shareholders know how to find out the balance sheet, either he can be happy or not. So if he sees that provisions or the reserves and deferred tax payment, he sees that he's on the safer side, the company is doing well. That is how they make the P&L account according to the Companies Act, so that the shareholders will be happy and they can invest more on the company. So you're going to add everything, and then you're going to add the amount here and find out net profit plus all this expenditures which is to be added for P&L account. So here it is given the word called pride. For everything it is called pride. This is because PRIDE. So three P's we have. R we have one, and I we have one here, income tax and the interest. Then depreciation, deferred tax and dividend is 3, and expenses is E. So if you remember, net profit plus pride and P cube, R1, I1, D cube and E1, it becomes easy for you. Next, you're going to less. Less the following credits made in the P and L account. So here it is very important to understand the first part, that is brought forward business loss as per the books of accounts or unabsorbed depreciation as per the books. In the normal provision of the income tax, what we do, we also take the brought forward business loss as well as unabsorbed depreciation. But in this case, what we do is we take out of these two whichever is less, that will be allocated here. Next is reserves, that is amount withdrawn from revaluation of reserves. Reserves minus, that is amount withdrawn from revaluation of the reserves, sorry, not minus, reserves, amount withdrawn from revaluation of the reserve, or depreciation made on revaluation of reserves during the year, whichever is less, you're going to add here. Next, another reserve, that is withdrawn from any reserves other than the revaluation of the reserves, you're going to add here. Next, income, that is profit that they have made from the sick industries. Before the industry was not doing well, now it is doing well, incurred the income, so that is being added here. Now income from tonnage taxation company, that is nothing but the income from shipping company, you will add here. Income from undertaking exempted under section 80 HHC, 80 HHE and 80 HHF. So income that is been undertaken under exempted incomes, undertaken, and it is shown here, added here. That is when it is coming for 80 HHC, remember the last word C, it means it is for the custom, and mostly it is for the exported business only. And next, when it is coming for 80 HHE, again you remember E stands for electronics, so here it is only for the export of computer software, that is any deduction that is being done on the profit from export of computer software. In the same way, when it is coming for 80 HHF, it is the software related to the film. So any software that is related to the film and that has incurred a deduction in respect of profit from the export of films. So you are going to write here. Next is depreciation as per P&L account, that is you are excluding the depreciation on the revaluation reserve. What on the addition time you are going to do when it is going to be added with the P&L account, what the depreciation will be, including the depreciation on the revaluation of the reserves. When you are going to reduce from the net profit depreciation as per P&L account, you are going to exclude depreciation on the revaluation of the reserves. So you are going to write down here. Now deferred tax, any reliefs that is been received from the authorities, you are going to write here. Here deferred tax when you had paid in advance, that will be written here, or any amount of deferred tax which may be in different cases. Then next is exempted incomes. Exempted income, as I told you, the exempted incomes are section 10, 11 and 12, except under section 10, 30, subsection 38. Suppose in the question it is come, the company is covering the exemptions under section 10, subsection 30, and then it will not cover MAT. So if the company wants to cover MAT, then it will uh, include section 10, 11, 12, leaving 10 subsection 38. So every these credits information you are going to add, and you are minusing it with this value. Once you minus it with this value, you will get the book profit on which the MAT is been calculated. So here when I'm going to see on the first side, I told it is pride, PRIDES. So in the second side, I can say you it is a bride. It means it is very easy now to remember. What you have to do for the calculation of the book profit is profit and loss as per the company's account, either profit or loss. Then add pride minus bride. So B stands for brought forwards, either business loss or unabsorbed depreciation. Then R stands for reserves. We have two reserves. Reserves, uh, amount withdrawn from revaluation of reserves, or a depreciation made on the revaluation of reserves during the year. So whichever is less. The another one is reserve withdrawn from any other reserves other than revaluation of the reserves. Next, income. Income I from the SIC industries or shipping company, or it is from exempted income from under section 80, HHC, HHE and HHF. So 3I. So IQ. So B1 R square IQ. Then D for the depreciation, excluding the depreciation on revaluation reserve deferred tax. So D square. E exempted income 1. So if you remember, net profit or loss plus pride minus brine, then you come for the book profit. On this book profit, you're going to add 18.5% of the rate of tax applicable as a MAT plus surcharge. If surcharge is applicable, if it is more than 1 crore, 1 crore to 7 crores, then it is 7% plus 4% of education cess. Thank you.